Tesco's is a well-known household brand in the UK, an absolute juggernaut of a supermarket. With stores primarily based in the UK and Ireland and some in Central Europe, they have a combined amount of 3,822 stores in the UK and Ireland alone. Whilst they do provide groceries and clothing as one of their primary sources of income, they also have Tesco's Banking and Tesco's Mobile. Alongside that, they have the legendary Tesco's Club Card, which rewards loyalty for all of their customers. In more recent times, they have been edging into the click and collect sector as well as delivery services. Value and cost saving is also a major driver at Tesco's. Alongside their club card prices, their Aldi price match and everyday low prices to keep up with all of their competition. When googling Tesco's ticker symbol TSCO, you may be greeted by Tractor Supply Co. over in the US. They are traded on the Nasdaq. In order to correct this, simply type in UK afterwards and it will bring you up the London Stock Exchange Tesco's ticker. A quick summary, we can see that Tesco's is currently trading at £2.24. They are down 23.49% over the past year, and we can see that their decline has been a slow one, but it certainly accelerated up to August, September and October of this year, recovering in November and going a bit stagnant over December. We'll certainly have to keep an eye on them into the new year. We can see that the market cap is 16.49 billion, a PE ratio of 18.15, a dividend yield of 5.14. We can see also that they were founded in 1919 and they have 345,000 employees and 57.89 billion in revenue as of 2021. You can also see everything news related to Tesco's PLC in this neat wee toolbar over here. Anything from Yahoo Finance, The Guardian, Daily Express and the Motley Fool will show up here regarding the Tesco share price. You can also go over to the compare where we can put them against some competitors such as the likes of Sainsbury's, Marks and Spencer's and B&M. Simply by clicking the plus symbol, we can put the share price side by side and get a view over the last year or the last 5 years and see how the stocks have been performing against one another. We can also go over to the financials to get the most up-to-date quarterly financials of Tesco's. Here we can see the August 2022 filings as well as May, February and as far back as November 2021. Jumping over to Simply Wall Street, one of the tools I use on my dividend journey, we can have a deep dive into Tesco's, all their financials and have a real good look. Based on their snowflake model, something Simply Wall Street uses quite well, they give a score out of 6 in terms of valuation of a company, their future growth performance, their past performance, their financial health and their dividend, of course. And we'll be going through each of these sections and having a look to see how Tesco's score. At the moment, they are an adequate balance sheet of fair value, they pay a dividend and their future growth and past performance isn't fantastic, but we'll look deeper into it. We can see at a quick glance here of all the risks. Is their dividend sustainable? Well, at the moment it's not well covered. Do they have high quality earnings? Well, large one-off items are impacting their financial results. Now, they are profitable. Earnings are forecast to grow 8.5% for the next 3 years. They are in a good financial position. Debt is low and not considered a risk. And their share price is pretty liquid and stable over the last 3 months. Now, with that all in mind, we can scroll on down and find that their competitors consist of the likes of Sainsbury's and Marks and Spencer's. Sometimes the competitors can be a little bit off, such as Naked Wines and X5 Retail Group, but I certainly take on board the likes of these two. On down, we can see their price history and performance, as well as their dividend being increased there back in October. Any recent news is also displayed here. We can see shareholder returns and their price volatility. Considered against their industry, Tesco's are considered not as volatile as the whole market. We can go down here and see that if you want additional information on the company, you can obviously hit see more and look more into it. And when it comes to their fundamental summary, let's have a wee look here. We can see earnings was 951 million against a revenue of 63.3 billion. Pay ratio sits at 17.2x and their price to sales ratio is 0.3 times. We can see here on their earnings and revenue, they made 63 billion to 58 billion in cost of revenue. That leaves them a gross profit margin of 6.5%. and a net profit margin of 1.5%. Supermarkets are notable for the fact that their profit margins are so razor thin, sometimes making pennies on, a tin of beans, for example. We can see here their payout ratio is 92%, considered quite high, and their yield obviously is 5.15%. One of the first valuation metrics they'll be using for Tesco's is their PE ratio. At the moment they trade at a 17.2 times coverage, and we can see that with their forward PE and a forecasted earnings in 12 months, that changes to 10.9. Simply Wall Street, of course, makes it very easy to follow along with any of these by just hovering over them with the question mark. You can see here in their price to earnings ratio versus peers that when it comes to the likes of B&M, Sainsbury's and Marks and Spencer's, Tesco's is considered one of the higher at 17.2, whilst their competitors sit at almost half that value. Something to bear in mind. Looking at their share price versus a fair value on a discounted cash flow model, we can see that it's currently sitting at 46.9%. We can also combine a DCF model with a relative value given intrinsic value. Over an alpha spread here, we can find out that the intrinsic value is £6.82, a 67% undervaluation from their current price of £2.24. We can see a future growth. Tesco's is forecasted to grow 8.5% annually for the next 3 years, which is obviously a good thing. Earnings forecasted to grow and free cash flow is forecasted to decrease. But again, these are over the next few years and we'll have to see how it all plays out. When we move on to past performance, they also score only 1 out of 6, but they do have a historical annual growth rate of nearly 5%, growing in revenue from 53 billion and a 0.5% profit margin back in 2016, all the way to nowadays where they are at 63 billion in revenue and a 1.5% profit margin. Let's look into Tesco's financial health. Well, they score 4 out of 6, which is pretty reasonable. A lot of it comes to do with how they can cover their current debt. Now, in terms of financial positions in short term and long term, their assets in the short term do not cover their short term liabilities nor their long term liabilities, but their long term assets do sit at 34 billion. Now, when we go down to their debt equity history and analysis, we can see that they have a reasonable 55% debt equity ratio. And when we throw in cash and equivalents, they have about 4.1 billion in cash and equivalents sitting about. Tesco's is also considered quite well when it comes to covering their debt by operating cash flow. Sits at 46% at the moment, and their interest payments are well covered at a 4.5 times coverage. We can go on down to see their balance sheet, physical assets, long-term cash, inventory and receivables against the likes of their debt and other liabilities. When it comes to their dividend, they scored 2 out of 6. It's notable and it's covered by cash flow. It's not high, not stable, not growing and not covered by their earnings. Well, so far as we can see. Let's see if that is the case. Industry average for consumer retailing sits at 5.4%, and it is forecast to drop 0.1% in the next 3 years, which for some people may not be seen as all that bad a thing, because as long as they're not cutting it majorly, a dividend is still a dividend. Now, going down here, we can see that they completely cut it back in 2015-16 and restarted back in 2017. Since then, the wee turquoise line, the dividend per share, one of my favourite metrics, has been growing steadily. Their yield, again, has been fluctuating with their share price and is currently sitting at the 5.2% that it is now. It is forecast to somewhat maintain and maybe grow in the next 3 years. If you've ever wondered how much Tesco shares you would need to make, say, £100 a month, then look no further at this dividend calculator on Dividend Watch, a website I use to track all of my dividends and my portfolios. Now, you would need 15,000 shares valued at £33,500 at the current market price and at a yield of 5.15%. Now, not including any additional investment, income tax over 5 years and reinvest in the dividends, we can see how it'll turn out in 5 years if, I was to just spend this money. So, we would see £1,200 in the next 12 months, so £100 a month. And we're going to reinvest them back in, and you'd see the next year we would be making £1,318, then £1,448, and so on and so forth. It would increase year on year. That is because the compounded interest of reinvesting the dividends in the long run is why dividend investing is so effective in a lot of cases. Now, these are theoretical, and obviously markets fluctuate, the price would fluctuate, and how many shares you would get for reinvesting the dividends based over, the share price increasing or decreasing over the next few years would have a massive effect, as well as whether they cut the dividend, increase it, or maintain it. These are obviously factors that all dividend investors have to consider. But yeah, that gives you a wee bit of an overlook, doesn't it? When it comes to learning about a dividend of a company, Dividend Max is one of my best free tools that I personally use in all my videos and for my own investment journey. We can see here it gives a summary on Tesco's PLC. So the dividend is expected to go X in 5 months. That date is the 18th of May 2023, meaning you would need to own the share on the 17th of May. Always remember, it's the day before the X dividend date that you need to own the share in order to be entitled for the dividend payment, which is paid out usually on the pay date. Declaration date is just when they announce the exact amount that they are paying. From here we can see whether they cut the dividend, maintain it, or increase it. And normally there's a lot of news articles and hype leading up to that point. One of the best sections of Dividend Max is their annual dividend chart. It is from here you can see how it has been progressing over the past 15 years. And we can see that in 2015 and 16, Tesco's completely cut their dividend, not paying it out. In 2017 it recovered, and it has continued to do so year on year even over the pandemic, growing at an average of 5.5% per year. Although it is jumping in major amounts, they maintained it in 2020 and it increased 19% in 2021. Hopefully we'll see by 12th of April 2023 whether that continues. When it comes to the management of Tesco's, the average management tenure sits at 4.7 years. Their current CEO, Ken Murphy, has a tenure of 2.17 years, and if we click show more, we can get the full breakdown of Mr. Ken Murphy. Always good to see what exactly he has been up to. We can see he served as a Joint Chief Operating Officer at Boots UK and Ireland. He has a deep commercial marketing and brand experience with Alliance Unichem and then Boots. Looking into the management of any company is clearly a really good strategy, and the leadership team at Tesco's is no exception, with an average tenure of 4.7 years. Obviously, that is not including any of them that might have moved within the company itself. We can also go down to the board members, and their average tenure is of 3.2 years, which means that the majority of them are quite experienced, all things considered, and most of them served over the pandemic. When it comes to the ownership of Tesco's, institutions make up 80.5% of all the shares. General public come in at second at 16%, and the Tesco's employee scheme comes in at 3.2%. We can go on down and see that the top ones include the likes of BlackRock, Silchester, Vanguard, Norges Bank, and Massachusetts Financial Services. The Tesco's employee service scheme sits at the 2.5% mark. My final thoughts on Tesco's is, despite all the headwinds coming up, things are looking pretty positive for them in at least the next few years. Of course, with the looming recession and many other economic factors coming into play, we will have to keep an eye on Tesco's and see how their dividend and their stock price performs in the next couple of years. If you do own Tesco's, let me know in the comment section below your thoughts on the company. It helps everyone, and I certainly enjoy the conversation. Thank you for joining me in this deep dive at Tesco's PLC. If you want to see another favourite retailer of mine, be sure to check out this video on Pets at Home. I'll catch you all in the next one. Thank you.